So onward we go to consumer credit, and consumer credit is pretty much what it says, what it states. So this is credit being extended to the consumer, to the individual households, persons within the household, etc. And it's an arrangement to receive cash goods or services now and pay for them in the future. That's again, buy now and pay later type of a scenario, and it covers pretty much all consumer credit, except for example, home mortgages, etc., by individuals and families. So this is not commercial credit, this is consumer credit. So this is between individuals or individual households and the institutions that would be involved. So the financing involves, of course, the alternatives would be trade-offs. The trade-offs associated with that: three ways consumers can finance purchases. One would draw on savings, so it would deplete their savings. Use present earnings, so cash for your current cash flows, or borrow against expected future cash flows or future income. Again, using other people's money, at least up front. But of course, you can't just, other people don't just give you their money. You would be borrowing it, and you would be paying interest, and in addition to that, the principal that would be associated with it. So if the first one, again, is if you use your savings, you would deplete your savings, reduce your emergency funds. Spending on current income will eventually reduce future well-being, and spending future income now reduces funds available for future expenses. Again, nothing is for free. There's always what opportunity cost involved, trade-offs that would be involved with it as well. So things to consider, avoiding or trying to avoid the misuse of credit. Before you use credit for a major purchase, consider the following questions. Do I have the cash for the down payment, for example? If you want to buy a car, for example, you'd like to have some money down to pay for that car. And the reason you want to do that is that oftentimes if you do put money down, you end up with a bit lower interest rate, because the lender is saying, yes, you're a good risk because you have some stake in the game. You've got some, you've got something to lose, right? Not just the vehicle that you purchase, but also the down payment that you put down on the vehicle. Do I want to use my savings for this purchase? Do I want to deplete my savings? Does the purchase actually fit my budget kind of going forward? Could I use the credit I need in some better way? Remember, you're evaluating alternatives, opportunity costs. Can I postpone this purchase? Rather than buy this new car right now, can I wait a month? Can I wait a year and continue on with my current vehicle and just continue to maintain it and just kind of nurse it along? Again, all this opportunity costs that are associated with postponing this purchase. So, for example, again, with the vehicle, yes, you could probably do it for another year, but the problem is you don't have reliable transportation, and that could have a deleterious and negative impact on your job, for example. What are the dollar and psychological cost of using credit for this purchase? Because remember, there can be a heavy burden. It's that a buyer's remorse that strikes always, whether we're talking about whenever we're using any funds, whether it's out of our savings or making the purchase, etc. There's always some cost associated with this. So the importance and advantage of credit is that credit is a major driver in the U.S. economy, and people tend to think about it in negative terms, but there is a positive aspect of it as well, right? If without credit, you could not buy that home, and this is not consumer credit. When we're talking about consumer credit, it's everything but home buying, but it's the same idea that to raise families is not cheap, and you have to borrow in order to do that oftentimes for any variety of reasons, whether we're talking about borrowing in order to buy Christmas presents or to pay for braces for a child or whatever. There are costs that are associated with it, and having access to credit is very, very important. So again, having access to credit doesn't mean you have to use it, but access is very important. So you have access to immediacy if you need to go out and buy something immediately, whether for a financial emergency or what have you. Advance notice of sales, meaning again that something is is going on sale, and you can go out there and make the purchase right now. Buying airline tickets. You don't buy your airline ticket the day of your flight. You try to time it a bit earlier so that you can get a reduced rate. Things along those lines. It's convenient for shopping, whether it's going through the line at McDonald's and using your credit card to pay for it or not. Um, it's easier to deal with oftentimes than cash. And the monthly payments are straightforward. You know when the payments are due, when the bill is going to come in, for better or for worse, but at least you know when it's coming in. You can take advantage of float time and grace period associated with purchases as well. Meaning, for example, you may buy something on, we'll just say October 21st, and you wouldn't have to, no interest would be accruing until November 21st. I'm just using the dates, but there's usually a several week, maybe up to a month period of grace, a period where you're not being hit with interest on your purchase with using credit cards. There might be rebates associated with travelers and like American Express cards, Citibank cards. Often they offer they offer travelers incentives, if you will. You get miles and so on and so forth, where you can build up by using your credit card. You're able to get free flights, and also using a credit card, you've got a much stronger case in terms of if you want to return something. Because you have the power of that credit card company behind it. The disadvantage, of course, is that it's too easy. Your strength is your weakness. Yes, it's easy to access, but it may be too easy. If you don't, pay your bills on time, you could run into significant problems as a result of which, and again, accessing this credit does cost money. Otherwise, why would the credit card companies be in business? It does not impact your total purchasing power, because all you're doing is you're buying it now and paying for it over time. Presuming, of course, the fact that if you're doing that over time, then it's going to reduce your spending power going forward. So again, all these, whenever we're talking about accessing credit, the damages that could be plentiful. It could be amazing within families, the disruption that it causes when people are not on the same page so far as like using that credit that's available to them. So different types of credit, very, very straightforward. Closed-ended credit would be, again, when we're talking about mortgages, auto loans, installment payments, to pay for something over a period of time, a set period of time to pay for appliances, etc. Open-ended credit, this would be the typical credit card where you're buying things on a daily, weekly basis, and you would be hit with the charge after that next month, and then the interest would start accruing at that point in time. So it's the number is going up and down depending upon the usage of the card. So anyhow, it's the idea again. The two differences: the closed-ended would be something set in terms of like an auto loan, and open-ended would be the typical credit card that you would have access to. So with all those cards in your pocket that you have, or your digitally, if you will, we have credit cards. Those are again Visa and MasterCard and Discover Card. Those are the big ones, along with like American Express, and there are a few others out there as well. But you have access to credit, and you can actually use it to get cash advances if needed. So it's something that 7 out of 10 U.S. households carry one or more credit cards. So about half of all credit card users are for convenience, and they pay their balances in full every month, which is a good practice to have. So it's important to have credit, believe it or not. Yes, it is. I'm joking. Of course it's important so that you can have access to these things, but ideally, again, as it indicates here, that half of the people that actually use their credit cards pay their balances every month. meaning the other half do not, meaning that they carry balances, which means that there's interest being paid to the credit card companies. Other types of cards, smart cards, debit cards. Debit cards are smart cards are, with the embedded chip. It's they're with all the information that is required on that. So it's and you have a chip embedded on pretty much all credit cards that I know of are smart cards now, where they've got the embedded computer chip, so you can just tap and use the card, or along those lines, you don't even need to tap as long as it can visually see something. But anyways, you get the idea. And the debit card, again, that's access to your checking account. So it subtracts money directly, immediately from the moment of purchase. So there's no delay in the payment. So you're accessing your bank account directly. And again, there are other cards that are out there as well that I had mentioned, that other choices like Diners Club, etc. They're very few and far between now. Most all of them are credit cards or debit cards is really what it comes down to. And smart cards are incorporated into pretty much in the mainstream now, that are part of credit cards and are part of debit cards as well. So again, when we talk about home equity loans, home equity loans are interesting in that what you're doing is you're borrowing against the value of your home. So let's just say, for example, you purchase a home for $200,000, and you have a mortgage on the home you put down 40,000. You're a good borrower, so you put down 20%. So you put down 40,000, so you owe $160,000 on the home. And what happens is that over time, the value of your home actually goes up, and as a result of which, you have access to more monies from your home. So you could take out what's called a home equity loan. So let's just say the value went up to $300,000. So that affords you more access to credit through accessing the equity, the value of that home. So in this case, when we're talking about equity, we're talking about your ownership stake in the home has gone up because the value of the home has gone up. So you can borrow against that. You can set it up like as a revolving line of credit. A lot of different ways to do this, but it's kind of a neat way, but it's a dangerous path as well, because obviously you're adding to what you owe on the home if you access that home equity loans, if you go that route. Debit card, credit card fraud, you have to really, really be careful as we're kind of moving forward. These are things that are happening with increased frequency. Credit card fraud and debit card fraud. Making purchases online, it's safe to a point until it's not safe, when you end up with issues. So this is when you have to be careful making those purchases. Be careful not to to use if you're at an internet cafe or whatever, be careful about using accessing your accounts in those type of environments. If you can have a VPN, you're much better off accessing things in that manner. Again, it's word of caution. Sooner or later, you're going to get hit with something that happens. Someone has access to your card. So it's that quick response that's very, very important in this whole process, right?